Richard.
How you doing?
I'm good. How are
Good.
you?
I'm good. I was reading yesterday. There's this. Have you ever heard of this website? This service called what's it? Hello Landing.
No. What's
No.
that?
Okay, so they you can rent homes from them, fully furnished homes, for 30 days at a time.
What?
And so you can, what people are doing as a result of the pandemic, when they had this freedom, they were selling their houses, and they just go from city to city and live in a city for 30 minutes at a time. 30 hours, 30 years. What am I talking about? 30 days at a time. Oh my gosh.
We got a senior moment, 10 seconds in.
Yeah, 30 seconds at a time. They move fast. But but you can imagine you get a place downtown in some beautiful city.
That would be so cool.
Stay for a month. And then you just drive to another place,
You know what? Amazing? Actually, I gotta go.
I know, right? I thought you would be perfect for you. Now,
I would love that.
Now, my wife would not be happy for that. She might have a hard time even staying somewhere in one place for 30 days.
Yeah.
Because she has her cat, and stuff, and
Yeah. Well, moving around is hard. Like psychologically, they say it's really hard to move around a lot.
Right.
But how cool! I mean, if that was in Hawaii or something.
I mean,
downtown San Francisco,
Hawaii, LA, Chicago, in the right seasons, just move from place to place.
Hello Landing.
Yeah.
And it's different. How is it different than Airbnb?
I don't know. It's a good question, but they specialize in in furnished homes for longer term.
That's
like 30
really
days.
cool.
That's a great idea. People
I'm
are
just
loving
gonna have
it.
to go book one and take off.
How long would you do it if you could?
Oh man, well I would do it indefinitely if I could, but I have little kids, so I'm actually pretty trapped in my house because they have school and stuff, and we learned in the last 18 months that I'm not going to be homeschooling my children.
Oh yeah, that's
but in retirement,
idea,
I would do it forever. Yeah, that's something that I could totally get on board with.
I think I have like four months in me.
Yeah.
Then I want to come home and just be in my place again. Kind of get in my comfort zone.
This house too.
Yeah, and then I can go out and do it again. Maybe 4 months a year would be cool. Like I do them in a row though.
Yeah.
So anyway,
it would be awesome.
Welcome to a place of possibility. I'm Richard Del Monte.
And I'm Angela Wright.
And we are happy that you're here with us. And today we are talking about
annuities.
Annuities, right?
Annuities.
Yeah, and it's not as boring as you might think. It's very interesting, and there's a lot to it to
Says
know.
us, it's very interesting.
We're kind of wonky about it.
Well, okay, so a lot of people don't know much about it. They just think it's another kind of investment account that you can get. They don't know a lot about it. There's a lot of terminology. The contracts come, this thick, and most people don't understand what they're doing.
Right. They just shove them
when
in
they
the drawer.
Start one. Yeah,
right.
I mean.
Never read it, right.
Right, and, I just use a very important word, contract.
Right.
An annuity is an insurance contract.
Right. First and foremost. So it's not, people think it's like an IRA or something, but it's not. It's a contract.
Yeah.
So in that contract, there are some components, and one of them is there's an accumulation period. So when you put the money into it, until you start drawing from it or take it out, that's when it's accumulating. And the cool thing about the accumulation phase, one of the big selling features is it's tax deferred.
Yeah.
There's no tax while it's in there, which is good.
Yep.
Then what?
I'll do it. So you have the withdrawal period.
Yep.
So that's when you're pulling money out of the annuity contract, and that can be, it's usually a guaranteed income for a certain period of time, often tied to your life.
Right. And then there's taxation, and that's which I just talked about, and that is while it's in there, it's tax deferred. When you take money out, if you take out just like chunks that are kind of random or make a withdrawal every month, then it's basically what's called LIFO tax treatment, which means you pay last in, first out, which means interest first. So everything you take out in the beginning is interest until you run out of all the interest that it's made, and then you start taking out principal.
Yep.
So it's kind of the worst taxation you could imagine for that.
Yeah.
If you annuitize it, then when you take annuitize it means you take a set payment for a long period of time, like it could be 5 years, it could be 10 years, it could be for your life, 2 lives. Then a little piece of every payment is principal.
Yeah.
So and they figure it out, but that's how that works.
Right. Okay, so let's teach people about the terms, the terminology that you might see when you're buying this thing.
Right.
Okay, so the owner of the contract is the person that buys and controls the contract. It's your money that's going in, essentially.
Right. Then there's the annuitant, and that's the person whose life that the annuity is based on. That person dies, and it becomes it has to go to somebody else, or maybe it comes due.
Yeah,
right.
Exactly. Yeah. And then you have the beneficiary,
right.
And that's the person that gets whatever's left at the end of either the annuitant's annuitizing, or if they die, or sometimes you just can leave the account without taking withdrawals to your heirs.
Right. So there's lots of players, there's lots of bells and whistles in these things. Why do they exist?
It's a hard time answering this question. Sometimes.
Not just to make commissions.
I'm going to be honest. Yeah,
I know you're going to say that, but it's not just about that.
No. And we are. Our goal here is to give you a very fair look at annuity contracts, teach you what you need to know about them, and whether or not it's right for you. Obviously, we don't know your personal situation, so the little financial planner's disclaimer here.
Oh yeah,
it depends on your personal situation. So we're speaking in generalities here. So annuities are really great for providing an income stream that you cannot outlive. It's a guaranteed income stream for either a certain period of time or for your life.
So it's like a pension?
It's exactly like a pension. Okay. A pension is a form of an annuity payment, actually.
Right.
Yeah.
Yeah, exactly. Okay.
But we've been talking about fixed annuities, right?
Typically,
An amount of money goes in and a set payment comes back out.
Right.
But not all annuities are fixed.
No, there's two other types. One is a variable annuity, which basically invests the money in the stock market or, different kinds of funds, bonds, stocks. It could be a fixed account also, but it has that option to be able to do that.
Yeah.
And then the third one,
indexed annuities, where we're tying the returns to an index like the S&P 500, and they'll often put some buffers on it. If the S&P loses 10%, you only lose 7%. And if it gains 10%, you gain 7%, something like that.
The interesting thing about those is people think that that it's like a risk-free way to invest in the stock market, but it's not, because while they may limit the downside or even eliminate the downside of the investment, on the upside, it's usually capped at a certain amount per year or per period or whatever, and they get real arcane, how they do that.
Yeah.
And you don't get the dividends either on the investments. So they're capped.
And as we'll talk about later, you pay for that.
Yes.
benefit.
Everything that they give you that sounds really good inside of annuities, you pay for.
Yeah.
Yeah.
Okay, so let's review the pros of annuity contracts. They can be super useful in
Okay,
some
we're done with
cases.
that. What about the cons? No, just kidding. Just kidding.
No, they're really, and I'm going to share two cases today in which annuities are fabulous. So, okay, you have a lifetime guaranteed income. This is really helpful. Like, let's say you have somebody that's a spendthrift and they just can't control themselves. This is a really helpful way to keep them under control. They can't spend money that's not in their pocket.
True. That's very true. Right.
And it's
once it's annuitized.
Well,
Right. Yeah.
What else? You can leave money to your kids that way. Same story. You could leave it in the form of an annuity stream, and then they can't attack the principal.
Right. We have one client whose child is homeless, and they just don't have any access to funds or anything, and they were afraid that she was afraid that person would spend it all, and so they made it into an annuity, so he can't spend it. Yeah. What about Medicaid? You have an interesting story about that,
so
right?
this
Qualifying
is
for Medi-Cal in California.
Right. Medi-Cal in California, Medicaid in other states and other names as well. So you can use annuities to get rid of assets, essentially, so that the government will pay for your long-term care or assisted living. So here in California, you can only have like $2,000 and a primary residence to your name in order to get that coverage. And so some families will take, what the brokerage accounts and the IRAs and everything, put it into an annuity that starts to pay an income stream back to the family, but that process gets the asset off the books for that person that needs the Medicaid.
Yeah. But not just any annuity will work, right? They have to be specific annuities.
They need to be Medicaid compliant annuities, and there are Medicaid friendly annuities. You need to really watch out for that languaging, and there are specific ways that you have to write that contract in order to be eligible for Medicaid. I will spare you the details of that. And if you want to know, please call me and I'll tell you how to write one.
Okay.
But this is happening with a family that we have up in Oregon right now. Dad has dementia and he's in a home, and the family doesn't have quite enough to pay for all of this out of pocket. And so we used an immediate annuity. We took Dad's IRA, put it into what's called a single pay annuity. So we put one lump sum in and it will start an income stream. The annuitant in this case is the wife, because we need the asset off of Dad's books.
Yep.
And so she'll start getting that money back. And this is a fabulous way for them to get the state to pay for dementia care, which can go on for years and years and years.
Yeah, easily. And then there's a guaranteed death benefit in an annuity.
Yep.
Which is usually 100% of the initial what they call the premium, which is actually the money you invested in it. See, they're always using insurance language, premium, right?
It is an insurance contract.
Yeah, right. So they guarantee that, and so you get 100% of what you put in.
Yeah.
But the caveat is
You have to be dead.
Well, yeah, there's that. That's true. But there's a cost, right?
Yeah, you also pay a fee for that.
Yeah.
But so here's a scenario in which this worked out really well for a client. So they made a bunch of money by selling a business in 1999. They turned around and put all of it into an annuity in small cap stocks. So this was like $500,000 or so that they put in small cap stocks in an annuity contract. Well, what happened?
Let me guess. Woo, crash.
Yes, the dot-com burst happened next. Small and tech dove and dove and dove. And unfortunately for him, the account just drained down to like a couple $1,000s. So when I met him, he said, I have this bogus annuity thing with a couple $1,000s in it. Should we just cash it out? And I'm like, oh yeah, probably. I take the statement back. And then I start reading the statement and I see guaranteed death benefit, $500,000. And I go back to this client. I'm like, look, I know you have no money in this contract, but this is basically a life insurance policy at this point that you don't have to pay for anymore.
Right.
So you might as well keep the contract. And incidentally, that man died maybe 8 years later and his family got the money.
Yep. And people think when you have those situations that you have to leave whatever is remaining in the account there, but you don't to be able to get that death benefit. You could actually strip out everything else in there and leave just $20. And then you have $499,800 and whatever, $980 of death benefit. And that just will stay there for the rest of your life until you die.
I wish I'd known that at the time.
Yeah. That's a good little trick.
But so you can see how in some cases these contracts have worked out really well for people.
Yep, they can be for sure. Let's talk about the cons.
Well, how much time do we have?
Approximately
20 minutes. Okay, go.
The first one is big, right? And that is because annuities are tax deferred by nature, they don't really belong in a retirement account like an IRA or a KEO or a SEP or anything, 401k or anything like that.
Yeah.
Because you're just duplicating the effort. You're paying all these extra costs for the annuity and putting it into a tax deferred environment anyway.
And in fact, let me read you a statement from the California Insurance Commissioner's website.
Right.
It usually does not make sense to put your annuity into an IRA because the annuity already gives you tax deferral. It's right on the state commissioner's website. And the way we often see this happen is that people will retire or leave a job and roll their 401k into an annuity contract.
Right.
It's already tax deferred. You don't need the annuity contract unless you have spendthrift or Medicaid issues, as we were talking about before.
Yeah. And there's probably people who are going, oh my gosh, that happened to me, and that's unfortunate because one of the other downsides is you have to leave it in for a long time, right? Well, maybe should we get to that in a minute?
Yeah.
The surrender charge?
Yeah, well, they're not liquid. So often annuities come with a 10-year period. So the 10 years after you purchase the contract, you can't pull any money out of it.
Or a little bit, like 15% or something.
Some amount.
But you can't get it all.
Yeah. Or you can pull some, but some will get left behind as the surrender charge.
Right.
You'll see that. Or what you'll sometimes see in contracts, if you have a contract and you're wondering if you have a surrender charge, sometimes it spells it out with the word surrender. Other times you'll see like account value and then withdrawal value or something like that. The difference in those two is what you lose to the insurance company simply because they don't want you pulling your money out.
So for example, you might buy an annuity, variable, fixed, whatever, and say you put in $400,000. And then in the first several years, the payment to get out might be start out at $32,000. Like that's how much you have to give them to leave. Mm-hmm. And then the next year it might go to 30 and then 28 and 27 and 26. And then after 7 or 8, 9, 10 years, it goes to zero and you can get all your money back. Ugh. But that's a real pain. And why would they do that?
Insurance companies pay the people who sell annuities very large commissions. It's usually 8 to 10% of the amount that you deposit. Yeah. And so the insurance company needs to recoup all of that commission that they paid to the salesperson, and you have to keep your money in that account paying the little fees, which we'll talk about in a second, in order for the insurance company to make up all that money. So
you're saying if I put in $1 million that agent's going to get potentially $100,000 commission right then, right
That's exactly
as
what
soon
I'm
as
saying.
I put the money in?
That's exactly what I'm saying. So these aren't bad people, but we do need to recognize that there's an inherent conflict of interest when you're looking at somebody who's selling an annuity.
Right, for sure.
Yeah.
And you also need to know, which we're going to tell you, there's way cheaper ways to do this.
Yeah, totally.
Than go that way with all those costs and everything. Okay, another unfavorable aspect of a con about getting these things is unfavorable tax treatment.
Yeah.
Right.
Yeah. So this is a case when you're not putting money that was already tax deferred, like an IRA or something. But let's say I have $100,000 sitting in my bank account and I want to invest it. So I put it in something called a non-qualified annuity account.
Right.
I have a cost basis of $100,000 in that account.
Right.
When you pull money out of an annuity, we said this already. It comes out last in, first out, LIFO.
Right.
And that means that all the money I made on my $100,000 gets taxed before I get to touch that basis. I have no choice but to get taxed on all of that at ordinary income rates.
Ordinary income rates. What about capital gains?
You don't get capital gains when you put your money in an annuity. So had I just instead put that $100,000 in a brokerage account, I would be paying max 20% tax on all of the gains in that account, so instead of my ordinary income rate.
So basically, if you really wanted to get tax deferral, you could buy like an exchange traded fund, a growth fund or something that doesn't have any turnover.
Yeah.
And then just own it. And then when you get done owning it, you could sell it and you can get capital gains treatment.
Exactly.
Right?
Or
Instead
I could
of ordinary income.
choose the lots I sell if I want to take $20,000 to, down payment on a new car or whatever.
Right. And another aspect is the stepped up basis, right?
I wasn't even thinking about that.
Yeah.
Ooh,
no, the stepped up basis. So if you die and you have this annuity, your heirs are going to get taxed on whatever the gain is between when you put the 100,000 in or whatever it was and whatever it's worth that when they go to cash it out. Mm-hmm. And so that's all taxable ordinary income to your heirs. If, on the other hand, under current law, which may change, but right now it's this way, you died and you had that same kind of growth, then your heirs would have no tax because you get a stepped up basis on the assets because it's a capital asset. Annuities are not capital assets. That's the big difference.
Yeah.
So that's a huge difference to me, and so for the benefit of being in a non-qualified annuity of the tax deferral, there's myriad other ways of accomplishing that.
Absolutely.
Without the downsides.
Yeah.
Yeah.
Absolutely.
Right.
Okay, this list is long, so we're going to keep punching through it. Some annuities do not have cost of living adjustments on the payments. Instead, your payment is just fixed forever.
You mean when you take money out?
When you take money out,
right,
yes.
Right, okay.
And so, let's say you do the thing where you want the guaranteed income stream for your life. Your Social Security, for example, you get cost of living increases, so you can keep pace with inflation. In annuities, it's often just the $1,500 a month that you have today is the $1,500 a month you have in 30 years, and that's that. There's no inflation protection.
Yep.
If you want cost of living adjustments, you can certainly buy that from an annuity company by paying an additional fee through the years.
Right. You can get what you can variably annuitize it. Also, I think that's what it's called, and your payments will go up based on what the account value is, or go down.
Yes.
So they can go, it's be like the yo-yo going up the stairs.
Just like the same thing as if you have an account in the stock market.
Right, exactly. Exactly.
So, okay, let's run through some of the costs because we keep talking about it, and let's talk about how they're applied and help people understand, because it's not that easy when you're looking at the contract.
Well, it's impossible, actually. That for the average person, there's no way you're going to know how much you're paying because it's not really totally disclosed. Maybe if you pull through the different pages and everything.
Well, here's the terms you want to look for. So the base fees on annuities are called mortality and expense.
M&E.
M&E charges. Yep. And so they're typically like 1/4% to
more like 1%.
I was going to give you the whole range.
Okay, yeah. Okay.
Some annuities today you can find at 1/4%.
Yeah, right.
All the way up to 1.5% typically base fees.
And that's just to give you that death benefit guarantee. Yeah. Right? Which some of the times is less than what your account value is worth. Most of the time it's that way. Yeah. So you're paying for something you're not even getting for, any benefit from.
Right. And then on top of that, you're adding what annuity companies will call riders. Yeah. And so you could have cost of living adjustment rider, guaranteed minimum income benefit rider.
GMIB.
Yep. Long-term care. If you need to go into a facility, there could be riders to give you money.
Right.
What else?
Those are the biggest ones. But the thing that's interesting, those can cost a lot. They can cost up to 3% per year.
Yeah.
And so, for example, the GMIB is one that's really interesting because they are one of the biggest selling features of annuities. Mm-hmm. And I personally think that they are protecting against something that really is never going to happen, or the odds of it happening is infinitesimally small. Yeah. They're basically saying if the value of your investments goes way down low, you've lost like 70% of your money, we will still give you an income stream based on a hypothetical, like a pretend account value. Yeah. We'll give you that per year, like maybe 6%, 5%, depending on how old you are. And But what that's, the assumption is that you're going to have some stocks and stuff that are in there that are going to go down and stay down.
Yeah.
And those things have never happened except...
Unless you do what my uncle did and not diversify, you choose terrible investments.
That's true. Right, that's right.
You don't diversify your portfolio.
Yeah. I shouldn't say it can't happen.
Yeah.
And I have seen where...
In a globally diversified portfolio, it hasn't happened yet.
Right. And so the worst time was in like the crash of 1929 and the early depression. And people use that as an example where the stock market actually lost 80% during that period in the first 2 or 3 years. But adjusted for the cost of living, which went down dramatically, we actually had really severe deflation. Mm-hmm. You got your money back, your purchasing power back within 3 years after the crash of 29. So really, there's not really any de facto risk that you're spending 3 percentage points a year to protect against.
Yeah.
There is an example. My friend Les, who is brilliant, he did one where he had a person that was terminally ill, and so what he did was he invested that money aggressively, like pedal to the metal aggressive to see if he could make it really grow, with knowing that within 6 months or a year, if the thing blew up, his client was going to die, and then they were going to get that death benefit.
That's a smart way to do it.
So that was brilliant.
Yeah, and you're only paying the high fees for 6 months to a year because he's terminal.
Right, and that wasn't 3% because that was just the minimum. The death benefit
that's very
guarantee.
cool. Good
Yeah,
job.
that was cool. Yeah. Okay.
So then you have all these annuity fees, right? So we're up to 3%. And then variable annuities go ahead and invest in mutual funds. Mutual funds.
Do they have costs?
Yeah, they do.
Oh, duh.
And a lot of people don't know this or don't pay attention. Mutual funds have operating costs. And like low cost mutual funds, 0.3, 0.4%, fractions of percents. And that can go up to 1.5% for your actively managed funds.
Right.
So now tack on an additional percent for the mutual fund
or
operating.
2, maybe.
So now you're paying. So let's say you're invested in a variable annuity and the stock market or your investments, a diversified portfolio, returned 8%, but you paid 4% in fees. You only realize 4% of that. Now do that every single year. On and on and on.
I mean, it's just
ouch. It's unnecessary because again, when we look at the stock market returns year over year, I mean, you would be averaging 8% if you were in a diverse. I mean, it just doesn't make sense.
Right. It's just a big frictional drag on your portfolio that you don't know because it's not. They don't say, "Hey, this last year, here's your statement. You just paid 4% in fees."
Right.
They just show your net return, and that's all you see.
Okay, let's talk about your favorite con job on annuities. The bonus.
Oh, the bonus annuities. Okay. All right. So the insurance companies are really smart. They're very, they're devious. And they have these things where you put the money in their annuity and they'll say, we'll give you a bonus up front of 3 to 5% of what you gave us. So if you gave us $1 million, we'll give you 50 grand.
I want that.
And people are like, who wouldn't want that? Right? Well, where is that money coming from? Is this organization that's charging you, exorbitant rates? Are they really, philanthropic organization? All of a sudden, they're going to do you a big favor?
Of course.
No, they're not. It's coming out of your pocket. It's going to be in higher fees and surrender charges that are even worse if you want to get out. It might be, higher percentages. And so it's those things are just those are a con job.
Yeah.
Never, ever do those. I've never seen one that made sense. They are not giving you anything. In fact, they will cost you because the insurance company is going to make it back and then some on giving you that money. So don't fall for that.
And there's very compelling sales practices around that. They'll wrap that into your rate of return. So they'll say, you're going to be earning over 10 years, you'll have 40% returns because of this bonus. And I think that's not actually accurate.
No, it's not accurate. So, and there's just a lot of things like that that are just really challenging.
Okay, so the list keeps going.
We have more?
Yes.
We do?
Okay, so also, when you buy an annuity contract, the insurance company has a set amount of, or a set cash, I guess, of mutual funds that you can invest in. So they contract only with certain companies. You don't have the broad market to invest in, and you're really limited. Kind of similar to your 401k plan. You don't have access to every mutual fund ever invented.
Very much like that.
Like you would if you opened an account at Fidelity or Schwab or E-Trade, one of those, right? So you're limited on what securities you can choose, which means you might not get the best mutual funds that you're paying a percent to manage anyway.
Yeah, some do have a good stable of them, but most of them have a very limited one.
Well, they're often I used to sell Hartford annuities. We could only use Hartford mutual funds in those annuities. Right. That's true. So. Yeah. So you just have to be aware. There's so much that you aren't aware of as a consumer. Right. That, I have one more.
You got more?
There's just one more.
Okay. What is it?
That is that let's say you do a single pay annuity and you annuitize on a single life, which means, so like, I'm 70, I put my chunk in and I want money back for my lifetime. And let's say I've put, $1 million in this thing, and then I die at 72. I haven't, all of my money is surrendered to the insurance company. Right. It does not go to my heirs.
That's true.
That's pretty straightforward when you're buying the contract, but just, keep your eyes open on that. And so, that's a risk you take in a lot of things in life.
It could go either way, right? You could live to be 110 and really, really clean up.
Exactly.
Right? That's the risk you take, right?
Get your crystal ball out.
It's like an anti-insurance contract. Another thing, though, I have another one that came to mind while we were talking. Yeah.
Not even on our list.
Wait a little bit. We'll come up with more. Not even on our list. So they will advertise many times like, hey, if you annuitize this contract and you put it in, you're going to get 6% interest. But you're getting 6% in distributions, but part of it is your own money that's coming back. It's not yield.
That is shady.
And it's totally shady, right? You're actually annuities right now, a fixed annuity is probably making 1 or 2% max. That's all they can pay because that's all the interest rates are in the economy. So if, they're going to give you back your 1 or 2% that they've earning, and then they're going to give you back some percentage of your own money back, and they're going to call it income.
Ooh,
it's just again, there's just a lot of, not everybody, there's a lot of really good ethical people in the annuity business, in the insurance business, lots of them. But there's unfortunately it attracts a lot of the sleazy guys too. And I'll give you one example.
And gals, don't be sexist.
Yeah, okay, right. One example, when I first started doing IRAs way back when, it was like $2,000 a year to do an IRA. And they had an annuity that you could put in $2,000 and get a 25% commission on.
You got 25% commission.
I didn't know. I would never do that. It was, there was no way. Because, to get $500 off someone's $2,000, what are those fees looking like inside there? They were unbelievable. Gross. But I just saw them and like, wow. I could see if I was a guy that was like really struggling in the business, or a gal struggling in the business.
Thank you.
And, and then these could be attractive. Right? If you just don't have any ethics or whatever.
Well, it's not even that, right? Because I've worked on commission in this business, and it's not like you're unethical. It's like I'm not going to make rent this month, and I could put this person into a mutual fund, just a standard brokerage account, and I could make $500, or the annuity pays me $5,000. And I might be inclined, like rent's due, it's really challenging. And I think, anytime you're in a commission environment, you are going to be faced with that. And this is why fiduciaries are super duper important in this industry. If your advisor is not a fiduciary, and you're not, I think I could choose someone who's not a fiduciary, but if you don't know what you're doing, choose a fiduciary advisor. Which is
a good segue into the next part, which is...
Okay, like what if... we're probably depressing a lot of people right now who purchase annuity contracts that are like, guys, what am I supposed to do?
Right, you're in one.
I'm
you
sorry.
shouldn't have been in one or whatever. Now what do you do?
You have options.
Okay.
It's going to be okay. Talk about because you're old. Talk about the old annuities. Because you sold them.
I resemble that. Okay. So back in... it was actually even before my time, but in the Tax Act of 1982, I think it was ERTA, ERT, Economic Recovery Tax Act. Before 1982, if you had an annuity, when you took money out, it was FIFO. In other words, first in, first out, or principal first.
Yes.
And so the interest was deferred until the very end. That was a really good contract.
Yeah. So
if you have one of those that's pre-82, don't get rid of it. Because if you want to take money out, you're not going to be taxed on it right now. That's a good one. Then other than that, that's the only reason to keep one. If you have a surrender charge,
if you have a big surrender charge, hold out until that's over, and then do something. If you have lost lots of money in a variable annuity,
then you could,
and you have a guaranteed death benefit, hang on,
or take out everything except for the bare little minimum, like $20.
Yeah,
right?
Yeah,
and
Okay.
Then, if none of those apply. And by the way, you could transfer non-qualified annuities, which means they're not in a retirement account, tax-free, kind of like using a IRS code section called 1035, which allows you to just roll from one to another, kind of like if you roll one IRA to another, or if you buy a rental house and sell it and buy another one. Those are usually tax-free exchanges. So you can do that tax-free.
Yep. So you have a non-qualified, or you have a non-qualified annuity that you could roll into an IRA.
Right.
You can roll any annuity. You can roll a qualified annuity into an IRA.
No, not if it's not qualified.
Right, they have to stay apples to apples, but annuities can be rolled into IRAs.
If they're an IRA annuity, yeah, right, for sure, yeah.
So you can get it out of there, but keep your tax deferral.
Right.
The point.
Okay, so we have a solution. We have our little rescue plan.
Terrible annuity rescue plan.
TARP. It could also be troubled asset target, rescue plan, like what they did in 2009.
All right, so what do we do?
So you would do a tax-free exchange into a low-cost annuity that doesn't have commissions. So there are some at Vanguard. And
Vanguard's like the king of low-cost everything.
I think T. Rowe Price has one, too. There might be some other organizations. I think, what's the one? The CREF, TIAA. Yeah. They have one. And but the best one that we like the most is through Nationwide, and it's called the Nationwide. What is it? The Monument Advisor. That's what it is.
Yeah.
And so that one, you can roll in, and the only charge, if you don't want to get any bells and whistles, which we're telling you probably don't need, is $20 a month. That's the only quote M&E charge. Yeah. So you could have an annuity worth $1 million, and you're only paying $240 a year in fees to have it. You compare that, even with Vanguard's annuity, they're charging like 0.35, I think, of a fee for that. So just the difference in price is astronomical.
It's a really good deal.
0.35, an example, on $1 million is $3,500 versus $240 with the Nationwide. So, and there's no one's making any commissions or anything. You can just roll into it. It's a really good deal. I will say that if you're over 60 and you're doing a roll now, prepare to go through the Israeli
Inquisition,
the terrorist Inquisition.
Yeah, right? So I mean that's a testament to unfair annuity sales practices. The fact that if you're a senior, you have to go through. Like, you have to get on the phone with the annuity company and go through an interview to prove that you have the capacity to sign the thing, because these companies have been sued so many times. They're covering their you-know-whats. And there's all of these disclosures that you have to sign. There's what's called a free look period that you get, where you can change your mind after a certain period of time. I mean, it's a rigmarole that you have to go through to get this. And what does that tell you about these things? Yeah,
that's why, because they're recognizing the risk that's there with people that are not scrupulous.
Yeah.
And the Israeli comment that I was coming up with, just to be clear, is if you've ever flown to Israel and you're trying to go through the airport,
I don't know.
Oh my gosh! I mean, they have agents that are there and they're questioning you in line. They got guys watching you, and they bring you into a room.
Oh,
why are you here? They break up husbands and wives.
Oh no!
Why are you here? They're really the
most difficult customs you've
really
been
hard.
Through.
So that's why I'm relating it to that experience. Gotcha. Okay, it was, nothing about Israel or anything like that. Yeah.
Oh man. Okay, so that's a lot.
What if you have money in an IRA, like an annuity that's in an IRA or 403B or something like that? What do you do? Just roll it out. Get it out of there.
Roll it out into an IRA.
You don't have surrender charges. Get rid of all those layers of costs and save yourself potentially thousands of dollars a year in fees, right?
Okay.
Yeah. Okay.
Let's take some questions.
And you already covered working with fiduciaries?
We talked about fiduciaries. Okay, yeah.
Do we have questions?
We do. Let's see. Okay. How do I know if someone is a fiduciary? That's a really good question.
Great one. You make assumptions sometimes in the business, like,
Yeah, right? Really good question.
You just do that,
Sorry. So there's a couple of ways that you can find out. CFPs. No, that's not true.
Nope.
I was going to give you some misinformation.
It's really about their compensation, right?
Yes, it's how they're compensated. And so if they're a registered investment advisor, meaning they're registered with the state or the SEC, depending on how much money they manage, you're working with a fiduciary. And fiduciaries have ADVs and Form CRS. You can ask to read those. The forms,
they're online.
Yeah. And the Form CRS is a plain English disclosure of all possible conflicts of interest. And on that form, you'll see whether or not they're paid in commissions.
Right.
You can also just ask them, but trust but verify. Read the CRS anyway.
Some RIAs, though, are also licensed to sell products.
That's
so
true.
You have to be careful. So you have to just see, the question is, do you receive commissions on products that you sell? Yes or no? It's just like like a congressional inquiry. Yes or no, answer the question, but if they do, then you got to be really careful about, you need more information because you want to make sure that they're not going to sell you a product and get a commission on it.
Yeah.
But otherwise, if they're getting paid by fees that you're paying them to manage their portfolio or give them advice, that's a fiduciary. And what a fiduciary means that they have to treat you like their mother, or their father, that they're going to take care of you just as well as they would actually do themselves.
Yeah.
That's
your
the
interests
standard.
First.
Right.
Yeah. Good question. Well, not a lot of questions on annuities here today.
Okay. That's all right.
Our audience may be snoozing. I don't know. Enjoy your nap.
Yeah. Wake up to get back from lunch. Right.
I know. And so we will have show notes. We'll have some, some of this written out for you. So it'll be posted to our website within a week or so. So you can look for that. If you do have questions, if you have an annuity, if you're feeling worried, you can click on the link that we'll post here to our calendars, and you can just schedule a free consultation with us for 30 minutes. We'll help you review what you have.
Yep.
We'd be delighted to do that.
Yep. Zoom, phone, whatever you want.
Yeah.
We'll
Thank you so much for being with us today.
It was really fun.
Yeah.
We hope you enjoyed it and it was worthwhile for you. Until next time, which will be in 2 weeks, we will see you then. And remember, you're invested.
And so are we.
Thanks very much. Take care.
Bye.
Bye-bye.